the reality is innovation doesn't stop, and the next 5 years are going to be so explosive. By 2030, I think we'll have seen more fintech companies created in the next 5 years than in the previous 20, which is basically the entire history of fintech. I think it's a very exciting time. I've never been more excited than I am right now about what the future for this industry holds.
Hello, this is Shawn Budde of Ensemble X, and this is the Ensemble X Exchange podcast. Today I'm talking with Peter Renton, the CEO and founder of Renton & Company, a fintech consulting firm specializing in media, thought leadership, and event support. Previously, he was the chairman and co-founder of Fintech Nexus, formerly known as Lendit Fintech. Peter has been writing about fintech since 2010, with over 2,500 articles to his name, and is the author-creator of the Fintech 101 podcast, the first ever fintech interview series of its kind. Additionally, he is an advisor for several niche fintech events and helps connect people together within his vast network. Welcome to the podcast, Peter.
Thanks, Shawn. Great to be here.
So before we jump in, I want to hear about your backpacking experience. I gather you live in Denver and you've roamed the mountains.
Yes, I've always been a keen hiker. I used to go and hike 14ers, which is the 14,000-foot peaks here in Colorado. We'd always do one or two of those every year. And then the pandemic hit, and I was thinking we couldn't really go anywhere. So I thought, you know what we can do? We can go backpacking because that's socially distanced and very safe. So just did a first backpacking trip. I think it was summer of 2020, just went up into the mountains, did a little bit of the Colorado Trail, and then every summer since then, we've gone up the mountains. Just usually, 3 or 4 days, 5 days is the most we've done. Just absolutely love getting away. I mean, some of these trips, we don't have a cell phone service for like 72 hours.
Right.
You're really in the middle of nowhere. We had one last year where we didn't see another human for 24 hours because I pick these days I pick not really routes. There's trails, but they're not really a known route.
Right.
I just combine like 4 or 5 different trails into what we want to do. And so we camped by this river, no human around. It was fantastic.
When I left, I guess my last official job before we formed this company, I decided I wasn't going to waste unemployment. I actually signed up for a surf and yoga camp.
Nice.
Only to discover a day later that it was actually for women only. And my name was androgynous enough that they didn't capture that.
Right.
So I opted out of that and I ended up doing a hiking trip. It was the first time I'd gone hiking. I borrowed equipment. I apparently was immediately identified as an amateur because I had an external frame backpack, which was, I guess, extraordinarily retro.
Right.
We were outside of Santa Barbara. I forget the name of the forest there, but same thing. We could go days without seeing anybody else.
Yeah.
It is a fun adventure.
I love it.
So I gather the 14s were day trips.
Yeah, the 14ers, that's been a day trip. It's a very early morning. Usually get up about 4 on the trail by 5. You got to be off the mountain nearly by noon. And so, because the storms come in.
Oh.
Particularly in August, which is the month you really want to do it because there's no snow.
Right.
The storms will come in starting around 12, and it happens not every single day, but most days. So you've got to be up early and get it going.
All right. That's an adventure then. All right. So let's jump in. You started your business in 2010. I started my career at Citibank Capital One. I was in financial services and kind of found my way into fintech when I co-founded Zest AI in 2010. You started in fintech about the same time, but you didn't come from financial services.
No.
So how is it that you found yourself to financial services? What did you do early in your career?
So I have actually a background in label printing. Although I went to college. I went to college for computer science back in the 80s. So dating myself a little bit there. But my father started a label catalog in Australia before I was born, and always wanted to expand to America. I was young and straight out of college, thought this would be a fun experience. So I brought the label catalog over to the US, ran that for 14 years, and then I could see the catalog business was getting harder and harder, and the label business was transforming. So sold that, started the first digital label printer in the country and built that up, and then sold that. And then I thought, I'm done with labels. And I took 2 years off, wanted to see what was out there. And I've always been a self-directed investor. I've loved investing. I probably should have been, an investor or banker or VC or something, if I'd had my kind of life over. But anyway, I discovered Lending Club and Prosper as an investor. So started investing in the loans, loved it. I also like to write, and I saw that no one was really writing about this, and I thought this is groundbreaking. First, investors for the first time could get access to the consumer credit asset class directly. And so started writing about it. That led to the conference. I built a following. Everyone said, you need to start a conference. So I did, and then started Lend It in 2013, built that up. And then obviously we had the pandemic where we struggled mightily, as you can imagine, and then sold that business to Fintech Meetup in 2023.
Got it. So let's talk about Lending Club and Prosper a bit. You were engaged in peer-to-peer lending early on. How have you seen that model evolve, over the last 15 years or so?
Yeah, it's been interesting because when I first got involved, I really thought this was going to just completely change the world. And it did in some ways because from a borrower experience, before Lending Club and Prosper, you couldn't really borrow money online or on an app. That just didn't exist. You had to go and do it in person pretty much. So they really revolutionized it from a borrower's experience. I thought from an investor, this was going to be a massive asset class.
And just to clarify, when you say as an investor, you mean someone buying loans or
Yes,
do you mean an equity holder?
No, I was not an equity holder. I did end up participating in Lending Club's IPO as an equity investor in 2014, but I was investing in the loans. I put, for me, significant capital to work and really was getting double-digit returns, thought it was fantastic. I thought this was going to just take off. The trouble with it, if you look all around the world, the only country where peer-to-peer lending really scaled was China. Yes, because there's a massive population there. And in China, they had fraud issues. We ran a conference in China for 3 years, or 5 years. We partnered the first 2 years. I know the Chinese peer-to-peer lending market really well. It doesn't really exist anymore. In its form, and that's what's happened. And that was because of government intervention and fraud really dramatically. And the US, it just didn't make economic sense. You imagine the average investor might have $10,000 invested. If you want to have $100 million of loans a month, you need tens of thousands, hundreds of thousands of these investors. That's an expensive proposition where you can go to, like Victory Park Capital or one of the private credit funds, and you could sign one deal and you can get $100 million a month. I love it from the borrower perspective. From the investor perspective, it never reached the potential that we thought it would. Although to this day, I'm still an investor. I mean, Lending Club shut down their program years ago, but I'm still an investor in Prosper Loans. I've had that account going since 2010.
Yeah, I think I've had it for almost as long when I first heard about it. And one of the things that we saw change is in the original day, you'd kind of write your sob story, right? Why you needed the money, what you're going to do with it, et cetera. And obviously, I think they've just turned into kind of every other kind of loan at this point in time.
Yeah, well, back when I first started investing, I would read every loan description and you'd get a little bit more insight into the person. Sometimes it was total bullshit, of course. There was they were just making up a story to get you money, but oftentimes it wasn't. And what I loved about it is that they would release all of the data attributes for each borrower. I mean, you're at Zest. I mean, that was a goldmine for a company like that, where you can really do a lot of analysis. Even someone who wasn't very, I had no background in statistics. I could download the data, put it into an Excel spreadsheet and do my own analysis. And, you could choose the loans that historically performed best and get some alpha across the platform. And that's how, I had double-digit returns like 5-6 years in a row.
Yeah, it was a good time.
Yeah.
So let's talk about one of the other trends that we've seen over the last 15 years. So I think you've talked about kind of the potential of open banking and embedded finance. How do you see those changing over the last 10 years and over the next 10 years?
Right. Well, open banking has actually been around in this country for quite a long time. Yodely's been around, I think, for a couple of decades. Plaid has been around now for a decade. And unlike other countries that were, like the UK was regulatory-led, we were market-led here with open banking. Still are. We still don't have the open banking rules, or the Section 1033 was released last year by the CFPB, but there was a lawsuit and there's still some question as to whether the rules will be implemented as written. I was reading Alex Johnson's newsletter yesterday saying that there may be a rescinding of the Section 1033. So anyway, open banking has been market-led, and I think that's been a good thing. Really, it has helped consumers in so many ways without and these consumers are even realizing it, being able to analyze, cash flow data, transaction level data has really helped consumers get more access to credit. You've got, all the data aggregation. I love that I can go onto my Rocket Money app and see all my credit cards, all my investments, everything sort of laid out. That's all because of open banking.
Yep.
What the companies like Plaid have done is enabled this to be a simple experience to connect your bank account, obviously with permission, but consumers will happily give that permission if they get something in return. And whether it's a better price for a loan or access to sort of all of your data in one place, I think it's going to be a godsend here. And I hope that it's going to continue regardless of what the government does, because, we're a very innovative economy, and, Plaid continues to grow. And there's Finicity, there's MX and others that have also made inroads in open banking and have helped, I think, lots and lots of companies implement open banking successfully.
Yeah, I'm a huge fan, and we've certainly seen it be very successful in other markets, like you say, where it's regulatory and therefore the coverage is 100%.
Mm-hmm.
And it ultimately, I agree with you, it benefits consumers. So then let's talk about embedded finance. How is that changing the landscape for other organizations?
I think it's changing it dramatically. If you were trying to start a fintech company even 10 years ago, you would have had to create a lot of things from scratch. And that is just simply not the case today. Obviously, buy now, pay later is an example of embedded finance that, has really taken off, where you sort of pretty much anyone now can plug that into their checkout and have an entire ecosystem of customers available to them. But outside of that, you look at the vertical SaaS companies that have really started, whether they were restaurants, whether they were yoga studios or hairdressers or whatever it is, they have provided lots and lots of services for a company to run their business. And now they're in financial services. That is made possible. They can add a lending program. They can have payment acceptance. They really can do a whole bunch of different products because of embedded finance. And you could start from scratch creating a fintech company today with plug and play of all these different, you can do wealth management, you can do insurance, you can do credit cards. All these things are now, because of embedded finance, much, much easier to implement than they were before.
So let's talk about that. There's kind of two ways that works out. One is you can buy a lot of stuff off the shelf, rent it, whatever you want to call it. But then there's also the BaaS kind of solutions, the all-in-one package. We've seen some trouble in the BaaS space.
Mm-hmm.
What do you attribute that to, and how should these fintechs that you mentioned that can kind of start from scratch very efficiently, how should they think about BaaS versus build your own?
Well, one of the things about this country that is different to other countries is that really to do pretty much anything financial that's customer facing, you need to have a banking license of some kind.
Yep.
You need to have a license. And the best way, the easiest way to do that for most fintechs has been to partner with a bank. And so there's a whole bunch of banks going back more than a decade. I remember with WebBank back with Lending Club and Prosper back in 2010, that was sort of the precursor to the BaaS as we know it today. And what I think, we obviously had the Synapse disaster, which I'm still frustrated and angry about, that came last year. But even before that, you saw consent orders coming from the regulators. Blue Ridge Bank was one of the first. Most of the BaaS banks have had some kind of consent order they've received. And partly that is because the BaaS companies wanted to attract the fintech companies, and the fintech companies wanted things easy and cheap. And if you want things easy and cheap, you're going to be cutting corners when it comes to compliance. And that was what happened in many instances. And I think that's a lesson learned from the industry. Compliance is one area that simply cannot cut corners. And the whole Synapse debacle, which I won't get into that much here, other than to say it should never have been possible for that to happen.
Right.
It's really a record-keeping problem that caused these customers, these consumers, to this day, still some of them have six figures, their life savings that they don't have access to, they haven't received back, and they may never receive back as that sort of the bankruptcy proceeding is winding down. And it really, record-keeping, there's no excuse for that. There's just simply no excuse for that. From a regulator's perspective, they should have seen that these records were being kept poorly. And from the bank, they should have seen that as well. And the intermediary companies should have been able to be transparent with their record keeping so every dollar was accounted for. It's just crazy that didn't happen.
It is crazy. One of the things I say is that 90% of fintechs are 100% tech.
Right.
And there's kind of the tech mantra of move fast and break things.
Yep.
And that, not so cool when you're holding other people's money. So how should those two, the regulatory landscape, the desire to move things forward and innovate, how do you balance those two tensions, if you will?
Yeah, I think that's the really key question. I think today the landscape has changed. I mean, the move fast and break things, I don't think there's one fintech in this country now that thinks that is still a really good idea. You can do it if you're doing like book recommendations on Amazon. If that breaks or it's only 90% accurate, it's not that big a deal.
It's not tragic.
But if you're doing it with people's finances, it is a big deal. It has to be not 90, not 99. It has to be 100%. That, I think, fintech companies have gotten the message that you really need to make compliance a core competency from day one. One of your very first senior hires should be a chief compliance officer. It's not going to be cheap, but it's going to save you in the long run because you can make sure that everything is built from day one the right way. And most of the BaaS banks that are still active, they're not going to let you cut corners anymore. People don't want consent orders to come into them. And so the landscape has changed. But, it's interesting because there are some, like I had a fintech on my podcast earlier this year talking about starting a BaaS program in 2020, and the bank they chose was giving them a really hard time, and they were tempted to go and choose a different bank that was going to give them a less hard a time. And they said, you know what, this is something we probably need to be given a hard time on. And they decided to stick with it. And they spent a lot more money than they could have. But now they're really happy that happened. And I think that's the sort of thing now. The sponsor banks pretty much all are much more conservative than they used to. They're going to push back if you want to cut corners. No more all about fast growth at any cost, or fast growth even as a goal that should be primary. You can't go 10x. Once you get to a certain scale, you can't go 10x a year. That's too much for the regulators to get comfortable with.
Yeah, we've worked with a lot of startups and worked with helping them choose a sponsor bank. And in some cases, we've definitely advised them against a particular organization because we didn't feel they were regulatorily strong enough. Mm-hmm. And while that probably feels fun at the start, it doesn't feel so fun when the regulators come in and either shut it down or pause it or whatever, and you're on the other side of that transaction.
And even with the new administration today that have really given much more of a hands-off approach to the industry, I don't think you're going to see people taking a more lackadaisical approach. They realize that even for the next 4 years, if there might not be any consent orders, everything might go much easier. They know that that's not a long-term best practice.
Right. You never know when it may change again.
Yeah.
So we talked about kind of the consent orders, what's going on with Synapse. So as you look back over your 15 years in this industry, what have been the pivotal moments? What have been the biggest innovations, changes, et cetera?
Oh boy, I would say there's been so many things that have happened. I think it's like I look back at 15, you go back to 2010 and you look at the fintech landscape. There wasn't really a fintech landscape. I mean,
right.
You had PayPal, you had Lending Clubs and Prospers. I think Square was just getting going right around then. There was some innovation happening, but not like we see today. So I think a few things that like the whole rise of mobile banking, I think mobile wallets, all of the payment technology that exists today that simply was not there in 2010, that's changed dramatically and is continuing to change. And obviously you've got all the crypto and blockchain developments. That wasn't really a thing, although I know Bitcoin had officially launched in 2010. Yep. No one really cared and no one was paying attention, unfortunately. If you go back in time, you would. I like some of the other pivotal things that I love the lending space, as I know you do as well. I think we've seen some really interesting things. I mean, the introduction of AI into lending happened very early. I mean, Zest was a trailblazer there for machine learning models using underwriting. That goes back probably over a decade. And more recently, the cash flow underwriting. I'm a huge fan of cash flow underwriting, being able to use what's in a person's primary checking account as sort of a predictor of ability to pay. Yep. I think that's been a great development. I love earned wage access as well. I think that's probably my favorite fintech invention of the last decade. It's had more impact on the people living paycheck to paycheck, I think, than any other innovation. And then, of course, we have to talk about all of the generative AI stuff that's happened. We're still in the very, very early innings, but that's going to be transformational.
Yeah. So you said you love lending. The stock market doesn't seem to love lending.
Nope.
So a lot of these companies got great valuations, went public, went through the roof, and then have generally, maybe all of them have kind of crashed back down. What do you attribute that disconnect to? I mean, I always believe lending is where the money's made.
Right.
Right. So why is it that those firms haven't fared better out in the public markets?
Well, my personal feeling is that these companies went to the public markets as a tech company and they were looking for tech company valuations.
Right.
And, like you look at, I was at the Lending Club IPO on the New York Stock Exchange. It was a fantastic day, full of excitement. The company ended, I can't remember what the valuation was. I think it was north of 10 billion at the end of day one. And there was a lot of other IPOs that happened over the last decade that had really lofty valuations. I mean, Upstart went crazy. Affirm was another company that really had just massive valuations. But the market suddenly realized that these aren't really tech companies. You can't scale this like you can scale a Google or a Facebook or even an Apple for that matter. These are financial focused firms. So maybe they should be valued more like banks. And that's what we've seen. We've seen the valuations come down. I mean, the companies that are profitable, I mean, you look at Nubank, they're a public company that's traded in the US, but obviously headquartered in Brazil and really big in Latin America. They're doing really well. Their stock price is doing quite well, but it's still not valued like a tech company.
Yeah.
If you look at banks, I mean, still the biggest banks have massive valuations, but JP Morgan is not $1 trillion company, and yet they make tens of billions of dollars in profit every quarter. If that was Tesla or if that was Facebook, they would be a multi-trillion-dollar company.
Yeah, that's fair. I've always said you want the PE of tech, but you want the E of lending.
Right.
So they probably are fairly valued, and maybe some of the tech companies aren't so fairly valued. So you mentioned Nubank. I would argue that one of the biggest innovations in fintech has been kind of the opening up of the rest of the world to lending. In Latin America in particular, some population has always had access to banking. It's kind of looked like private banking, but this more broader scale. So how do you see, is Latin America just going to be a follower and everything that happened in the US is going to happen in Latin America, or is it going to take a different path?
Oh, I think it's taking a different path. I wouldn't even call Latin America a follower anymore. I mean, they were for a while, but, companies like Nubank, they're blazing new trails. Brazil is an interesting company in and of itself because when Nubank launched, like a lot of countries, like I'm from Australia, we have an oligopoly with 4 big banks that control most of the market. Canada has a similar thing. UK has a similar thing. Brazil had a similar thing. Mm-hmm. But Brazil, they had terrible customer service, really high interest rates. And, David Velez, who I've got to know a little bit over the last decade, who's spoken at our events a couple of times, he saw that technology could really make an impact here. And so he's brought the cost of lending way down. He's transformed Brazil into a much more competitive landscape. And, where you've got, I think I've read just in their recent earnings call, they had 60% now of adults in Brazil have a Nubank account. That is staggering.
That is staggering.
I don't think there's 60% of adults in America that do anything that have any kind of financial product the same. So they've done a phenomenal job. And I think, Latin America, the thing is different. And when I tell Americans this because Americans in general are quite insular because we have such a massive market here. You don't need to go outside this market to build a very big company. But in other parts of the world, cross-border international expansion is considered a very early way to grow your company. So that's where Latin America has primarily one language. There is Brazil with Portuguese, but everything else is Spanish for the most part. And you can go and grow your company across borders. So there's been a lot of fintech developments for cross-border payments, cross-border foreign exchange, all those sorts of things that I think Latin America have done a phenomenal job in leading the world in some of those things.
Yeah, I agree. And I think what's interesting to me is lending is fundamentally the same all over the world. I say that, the ingredients change kind of in each market. What has struck me, though, in LATAM is there's so much focus on Brazil, Colombia, and Mexico.
Yeah, they're the 3 biggies.
They're obviously the 3 biggies, but it feels to me like there's some opportunity, as you say, kind of cross-border, rolling up, if you will, those smaller markets. And we haven't seen that. I haven't seen that happen just yet.
No, the Brazilian fintechs go to Mexico and Colombia.
Right.
There's not that many big companies that are doing it. I mean, Wala is a big Argentinian company. They've expanded into Mexico, and I think they're in other countries now as well. But when you combine them all together, it's a very, very big market. And there's some great companies in Ecuador. There's companies in Uruguay that are doing really well. I think the Latin American market is probably the most interesting area in the whole planet in my book.
Yeah, I agree. We spend a fair amount of time down there, and I think there's just so much opportunity, and they're great to work with. Mm-hmm. They're just really open and
really appreciative. They love working with the American technology companies and fintech companies, and they're just appreciative of what we can bring.
Yeah, it just makes it more fun for us.
It does, yeah.
We really enjoy working with them. So you started a big event, you've advised other events. So talk to me a little bit about what do people get out of those events? What are you hoping to deliver, and how do they contribute to the growth of the fintech industry?
I think events massively important. Now, obviously, I'm a bit biased. I started what became the second largest fintech event in this country. And I think when you bring people together, particularly when you bring a large number of people together, the conversations you have and the learnings that you take, it sort of builds on itself. You start on the first morning and you keep learning. And then if you go and you have conversation after conversation, and you can get a pulse of what's important, where are the challenges, who is doing well, who is doing poorly, just the side conversations you have at cocktails or whatever. Those are the sort of things that can't be duplicated any other way. It's really hard. We learned that when we had COVID, and we put on virtual events and they were okay.
Just not the same.
No one liked them. We didn't like putting them on. But we also felt like we didn't want to close our business down. So we did it, and it's all we had for a couple of years. And what we found, like, to me, the most fun event that I ever went to was our 2022 event in New York City. It was actually also happened to be the most financially successful event we ever did, because we were back to in person, and I had like 200 people come up to me and saying, "Oh, Peter, it is so great to be back. So glad you're back and we're doing this. I just missed events. I really missed them," because, while you can learn, like you can go to the keynotes, you can learn interesting things. You can also learn interesting things reading and watching YouTube videos. But what you don't get are the personal interactions. And we had a really popular meetings program that people would book, 20, 30, 40 meetings at a time. And again, that's a great way to kind of expand your business. But it's the side conversations, I think, that happen, the 2 to 3 to 5 minute conversations you have, and you can suddenly look back and you think, I had conversations with 50 people today, and I learned the pulse of the industry. And it also helps galvanize, when you've got industry challenges. I remember when the whole lending club debacle happened in 2016, and then we had our event in 2017, and it was almost like a rebirth of the industry, because if you're in lending in 2016 in this country, you had a hard time.
It was unpleasant.
You had a hard time because after the lending club forced LeBlanc to resign, no one wanted to invest debt or equity into lending. And so it was really hard for a long time. But then at our event in 2017, a lot of people saw that as the turning point where things started to get back to more of a semblance of normal, and there was money starting to flow, deals were starting to be made.
So you mentioned kind of all the 40 to 50 meetings a day. It can be a bit exhausting, but to do that, you need a lot of people. How do you get that inertia to get a whole bunch of people to show up to an event? Because the first time you do it, it doesn't have a reputation, right? You go to Money 2020 now, it's, I don't even know, 30,000 people. Chase is sending 200 people. But those first years, how do you get that momentum?
Yeah. Well, Money 2020 is not quite that big, but it's a hard thing. And what you've got to do, the secret to success in starting a new event is you've got to have the mindset that you are already successful. It's not like you're selling a software product or even a financial product where you've got everything buttoned up in advance. When you start an event, it's a blank slate. If you're starting an event, you hopefully have connections in the industry that you're starting it in, because you need a couple of anchor people to kind of get things going. When we launched our event, I had great relationships with the CEOs of Lending Club and Prosper and Avant and Best Egg and some of the investors that were involved in the space. So I told them we were doing this, got everyone early commitments, and they go, "Oh, if he's going to be there and he's going to be there and he's going to be there, I want to be there." And so what you've got to do, you've got to leverage your network, but more importantly, you've got to go out there confidently saying, this is going to be the best event. You can even, there's ways of wording when you're trying to invite big name speakers. There's ways of wording things that make it sound like you've already got lots and lots of people signed up and lots of great speakers. It's not easy. I'm helping a number of events right now. Some of them are first-year events. Some of them have been around for a while. And even one event's in its second year. Second year is so much easier than the first because you've got testimonies, you've got video and photographic footage of your event, and you're not selling a concept. But that first event, you've got to hustle. You've really got to hustle.
And then I guess inertia takes over, or at least helps.
Once you sort of get a couple of good events under your belt, people then look at their year and think, "Oh, I'm going to go to that event. I'm going to go to that event."
Right.
And so we would have a lot of people saying, "Well, the 2 events a year I always go to are Fintech Nexus, or it was Lend It, and Money 2020. They're the 2 events I go to every year. And I'll add a few of the other events in, or 1 or 2 of the others. But those are the sort of the 2. We were always in the spring. Money 2020 was always in the fall. And that's sort of a good way to look at it. And having 2 events in different times of the year really, I think, helped. That's one of the reasons why Fintech Meetup wanted us, because they wanted to be that big event earlier in the year. And so now they have that spot all to themselves.
So the great thing, as you mentioned, you have contacts across the industry. I think many of us are, kind of started here as operators. And so we had a very deep view. You've had a very broad view.
Yep.
So as you kind of look forward, what would you advise people who are entering the space now, want to start a business? What do you think is going to be the big transformations over the next 5, 10, 15 years?
Oh boy. Well, I mean, obviously, generative AI is going to have a massive, massive impact on financial services. We're starting to see it. There's not one area of financial services where I think generative AI is not going to have an impact.
Yep.
And so I think if I was starting a company today, I would make that front and center. You don't need to do an AI product, but you need to be using AI in a way from the get-go. And it's so much easier. You can leverage the capabilities of generative AI. And as a startup owner, rather than hire 10 people right off the bat, you could hire 2 people and leverage generative AI and really have a successful business. I've talked to a lot of fintech entrepreneurs and can't remember who first said it. It might have been Frank Rotman. I'm not sure, but it was fall in love with the problem you are solving, not the solution. And I think that's a really good advice because sometimes fintech companies, they fall in love with their solution to the problem.
Yep.
But if you really maintain focus on the problem, then you become a little bit more flexible in how you solve it. The reality is innovation doesn't stop. And the next 5 years are going to be so explosive. By 2030, I think we'll have seen more fintech companies created in the next 5 years than in the previous 20, which is basically the entire history of fintech. Because the barriers to entry, they're so much lower than they used to be. And with generative AI and embedded finance, you take those two things together, there's going to be a $1 billion fintech created, might have already been created and hasn't got that valuation yet, that's going to have 50 employees. And they're going to have a product that is loved by millions of people. I think it's a very exciting time. I've never been more excited than I am right now about what the future for this industry holds.
That's interesting. We saw the same thing with AWS, right? It used to be you started a software business and you had to buy servers and that's where you used all your capital. And then all of a sudden you didn't and you could scale it a lot. So I hadn't really thought about that. The creation of the tools, Gen AI really does lower the barriers to entry here.
Yep.
It's hard to feel that it isn't all just played out. Like everything's up to date in Kansas City. They've gone about as far as they can go. I'm going to come back to you in 5 years and we'll see.
Come on, Shawn. It's like there's so much transformation happening. I mean, just what stable coins, alternative payments rails. I mean, there's so many things. I think the lending space has really, plateaued in some ways. But I even think with that, there's going to be much more efficient ways of lending. There's still, to this day, you know this better than anybody, there are still tens of millions of people who don't have access to credit that should have access. And I think that is going to continue to be chipped away at that problem. There's new technology coming on board that will beget new technology that we're never going to stop. So I think there's going to be massive fintech companies that will launch in the 2030s that will be household names around the world by the end of that decade the guy might be in high school right now, or the woman might be in high school or college just with ideas. And in the 2030s, it's going to become a massive company. The innovation doesn't stop.
That's fair. I guess we thought it was all done 10 years ago and it wasn't. So
yes.
You're probably right.
It's never going to be all done, I don't think.
All right. So last question then.
Yep.
So an easier prediction maybe for you, or maybe not. What is Peter Renton going to do over the next 5 years?
So, it's funny because I loved running an events business, but it was a very stressful business to be in, particularly when you have the ultimate operational and financial responsibility for that event. And I do not miss running my own events business at all, like not for 1 second. But I love the event space. And so I've been helping out some nonprofits that I'm working with, like the Financial Technology Association, their industry group. I'm helping up their annual CEO Summit that's happening in a few weeks. I'm also helping out with the University of Utah's Stenner Center, the Fintech Exchange. That's another great event that I was somewhat involved with earlier this year, but will be much more heavily involved. Spring Labs has an AI native event that is with the state of Utah and Utah Bankers Association that I'm helping out. These are all small niche events.
Yep.
Much easier to manage, much easier to kind of produce. When you've done 5,000 person events, doing a 400 person event or a 300 person event or even or even less, it's just a much easier, I would even argue almost relaxing way of spending your time. And so I'm continuing to do that. I've got other fintech companies that I'm doing some thought leadership, media, PR consulting type work around, helping them get their word out. I love fintech. I'm writing again on fintechnexus.com. We sold that to a PR firm, the website. So people keep thinking I have control of that site. I no longer do, but I can put you in touch with the people who do. And I'm back writing once a month for those guys, which is a lot of fun too.
That's great. I totally get that. Like, I don't miss being in a large company with the daily grind. I love the opportunity to work with a wide variety of companies at various stages, and I understand that. Well, thanks for the time today, and to look into the past, to look into the future. Like I say, we'll come back in 5 years and benchmark this. Well, you can follow Ensemble X and Peter Renton on LinkedIn. You can visit us at Ensemble X, and you can find the Ensemble X Exchange podcast and Peter's FinTech One-on-One on all major platforms. Thank you, Peter, for joining us today.
My pleasure. Thanks again, Shawn.
And thank you all for listening.